Welcome to the What to Watch video update. This is a video that I do every week. And after I've looked through all of the charts, done all of the other videos, I sit down and I say, okay, what can we really look at that's happening right now to see, is the S&P decline that we've been seeing right now, is that almost over? Or are we just getting started and we're going to see further declines from here? This is being prepared for Monday, July 22nd. Before I get started, I do have a thing called the SPX investing program. It has now launched. Right now it's free. I will be locking it down in August. You can check it out. There are some additional videos that I have there that I don't post on YouTube or Rumble. If you want to get to that website, there's a link in the description below this video. There's also a link to other videos that talk about the program itself. Here's an email address if you want to talk to me about the program. When I do the videos, the video that you're watching right now is the What to Watch video. I also do a deep dive video, Intermarket Analysis, a weekly video, and then once in a while, typically now just on the website, I'll do supplemental videos. Well, all these videos together really tie into the daily video that I do. And that's the real foundation of the analysis and commentary that I provide. The weakness that we saw coming up this past week, we saw that happening in the daily videos. We didn't know necessarily how it was going to play out, but we saw things starting to appear and come together. That's where I feel you can get the most insight, is from the daily videos. Now, what I do with this video is I list a lot of the things that are positive, and some of those things could easily be taken as negative right now. Other things that'll come after this are things that are looking more negative, and if we start to improve, they could switch back over to the positive side. The first area is the advanced decline line. Yes, we've been going down. Yes, the advanced decline line based on price and volume are declining right now, but they're still holding up fairly well. This is an internal measure of the S&P 500. And when we take this in the context of the declines that we've been seeing up above, this is still holding up, in my opinion, pretty well for the time being. Now, we could see more weakness coming in here, and this could actually switch more negative. But for right now, I'm taking this as looking positive. Also, another internal measure that we look at are the new highs minus the new lows. We really dropped off on Friday as we saw the decline, but overall, we've been seeing a lot more new highs and really no expansion of the new lows. So for the time being, the 5 period is starting to roll over and we're topping out with the 10 period, but this is still looking okay. We'll be watching this day by day to see if there's more deterioration in this particular indicator. We also look at the advanced decline ratio on a short-term basis. That's based on 19 periods, and then 39 periods. That's more intermediate term. We are declining, but we're still above zero. And you're going to see that a lot in the charts. Since we dropped below the 20-period moving average, we're now starting to focus on the 50-period moving average to see, are we going to come all the way down to this level? And if we do, will this end up providing support? Right now, we're still above the moving averages, so this continues to be positive until proven otherwise. Here's all the moving averages together. We did come down to the 20-period moving average, but we lost that in Friday's session. Now, can we bounce back up and get above it? Sure, we can do that. But for right now, on a daily chart and on a weekly chart, this is looking weak, and it's really putting the short-term trend in jeopardy. In fact, we've already switched over to saying that the short-term trend is negative. Now we're going to be watching to see if it comes down to the 50. The Swenlin trading oscillator, after being really quite positive, is declining both based on price and volume, but still continue to be above zero. We're also declining with our 20, 50, and 200 period moving averages measured on the S&P itself. Even though we are seeing some weakness right now, they're still holding up for the time being. Now we look at the advanced decline line on the S&P based on price, measured in a cumulative basis. Okay, it's coming down, but not necessarily falling apart. We're also coming down when we look at this measurement based on volume, but not necessarily falling apart right now. This is encouraging, and this is holding up and is actually a little bit more positive. When we were going up, a concern was that the bullish percent index, which measures the point and figure buy or sell signals inside of the S&P, it wasn't going up. It was languishing. And in fact, it was actually declining. Excuse me. But as we've been coming down with the S&P, this means that the rest of the S&P 500 is holding up while we're seeing weakness in the bigger mega cap and even large cap stocks. Then we look at the vortex. When the green line's on top, that's positive, but we are declining. So it's positive for right now, but showing weakness. Then we look at just a daily score of the S&P 500 new highs minus the new lows. That's still barely positive right here. It's hanging on. Then down below is a 50-period moving average of the new highs, new lows taken each day. And on this next chart, this is a further blow up of that same chart where we're still having a tendency to go up. Now we could roll over and start to come down. That would be more intermediate term negative. Then we look at those stocks inside the S&P that are above their 20-period moving averages. We had come to a very high reading and now are dropping back, but we're still above 50. So for the time being, it's still positive. And here's a study that we're looking at where we saw last April a thrust from an under 10 reading to above 70. And then usually when that happens, good things happen. We're kind of comparing it a little bit to what happened in March of 2023. And then the S&P went up after that. Well, we saw that thrust and then the S&P did go up. Well, we started to get a real positive signal here, but we've been dropping back. We'll see, is this going to show further weakness or be able to turn and go back up? Then we look at those stocks above their 50-period moving average. We are declining, but we're still above 50. We're also declining with those stocks above their 100-period moving average, but we're still above 50. And we actually got to a really positive reading with those stocks above their 200-day moving average, but now this is starting to pull back. But for right now, all of these moving average studies remain positive, but showing weakness. This is a weekly chart of the S&P, and for the fourth week in a row now, we've been above this R2 level. Even with the decline that we saw in the past week, we're still above this level. So we'll be watching this to see, is this going to provide support if we see more weakness? Then we look at the S&P to utilities ratio. It is coming down right now, which could be seen as negative, but overall it has been going up. If this can turn and go back up, that would be more positive. And then we look at a broad market measure with the Amex, NASDAQ, and NYSE, and then take a 5-period moving average of the highs minus the lows. These are still holding up, meaning that the broader market is still hanging together for the time being. We look at the NYSE bullish percent index. This is actually looking quite positive. It ticked down a bit on Friday, but it's really showing that the broader market is improving. We're seeing weakness here in our advanced decline lines, but we're still above the moving averages with all the different indexes that we follow. Also, we're seeing a pullback here with the NYSE cumulative advanced decline line based on price, but we're still above the moving average. We're also still above the moving average when we look at the regular NYSE advanced decline line. And here's another NYSE advanced decline line, which is calculated slightly differently. It's also declining, but above its moving average. So this still is positive. We look at the common stock based on price, where we're pulling back now, but not necessarily falling apart. We're also pulling back with the common stock based on volume. The McClellan oscillator for the S&P 500, it is declining, but we're still above zero. Now, if we drop below zero, that's going to turn this negative. And we're still going up when we look at the summation index based on price. However, we're starting to turn over based on volume. The top area and the bottom area are two completely different indicators. One measures price, the other one measures volume. Sometimes with the bottom indicator, this can actually lead us, and that's what it did. When we started to go up, it started to turn up before price actually turned up. Well, now it's starting to turn down. Does that mean that this is going to be a continuation of a decline? We don't know that yet. We just want to watch this and see how things play out. Then looking at the NYSE McClellan oscillator, also declining, but still above zero. So we're still going up with the summation index based on price and volume. So the broader market is still hanging in there. Large cap growth is pulling back, but still above its 50-period moving average here. And this is where we're seeing a potential shift. As money has been coming out of the mega caps and the large caps and going into the small and mid caps, we're seeing this ratio really starting to come down. Now, just the reason why I'm taking this as positive, it's money's not just coming out of the market and going into a money market account. It's actually going from one place in the market to another place in the market. So we might be seeing selling in one area, but buying in a different area. And I tend to take that more as positive. We'll just have to see how the dynamics end up playing out. Small caps, this is what everyone's been talking about, really been shooting up. About the time everybody started to say, hey, the party's getting going, we've been pulling back. We're still above this R2 level. So it's still looking positive, but well off of the highs of where they had been. This is the Russell 2000 small cap index. We had become really extreme with the RSI, and we're pulling back now. We have seen a few down days as it's been giving back some of those gains. On a momentum basis, we're still positive with the small caps. Now, going back to this particular chart to the beginning of 2024, we finally broke out of this range here. Now, this is the S&P small cap index, not the Russell. But the Russell looks very similar to this. We've seen some fake outs before. Is that what's happening now, or is this time different? We can't answer that at this point. We'll just have to see how this plays out. Then looking at the small caps to S&P 500 ratio, it is improving, but when you look at the longer term trend of this ratio, the small caps still continue to underperform. The mid caps have been showing some improvement, but then giving back some of those gains. We came back down below the R2 level. We're still above this R1 level for now, and we're still above the 50-day moving average. Then looking at the S&P, which is a weighted index, and comparing it with the equal weight index, they're both going down more or less in tandem right now. So a decline is negative, but the fact that they're not really seeing a big divergence right now, I'm personally taking as positive. We're also seeing the ratio coming down here. The S&P 500, the weighted index, as money's coming out of the mega caps and the large caps and going into the rest of the S&P, that's when we see this ratio coming down. Sometimes that can be taken as negative because we're seeing rotation from money from one place to another. I'm still taking that as positive for the current time. And then this is another way of looking at that, how the S&P equal weight index has been underperforming the S&P, but it has been bouncing back lately. The total US stock ETF did set a recent all-time high, pulling back, but still above its 50-period moving average. Look at the regional banks. They've been showing some improvement too. Now, we're still in a downtrend when we look at this ratio between the regional banking ETF and the financial sector, but this is looking good, at least for the time being. The 10-year yield, we have been coming down. That was really helping stocks. What put stocks under pressure on Friday is we saw a real jump in the 10-year yield. If this continues to go up, that's going to be negative for stocks. If this can start to come back down, that will be more positive for stocks. Then we look at some ratios between the tech sector and the 3 to 7 year bond. We are coming down and we're coming into the rainbow, but all the lines are continuing to go up. We're still seeing where the market is anticipating a soft landing, even though it has been pulling back into the rainbow lately. And this is suggesting that the market is not anticipating a recession. Now, this could change, and all the economic news or some kind of an event could happen, and that could switch everything over, and we could, in fact, go into a recession, but the market is not necessarily anticipating that right now. Now, we look at a weekly chart of the NASDAQ 100. It is pulling back, but still above this long-term trend line going back to 2009. This is the NASDAQ 100 to Dow ratio. As the Dow has been outperforming, we're seeing this ratio coming down, but we're still above these breakout levels that we were at when we were really seeing more power behind the NASDAQ 100. Also, when we look at the QQQs and compare them with the small caps, we're coming back down, but we're still at this breakout point for the time being. What we're going to be waiting to see is this going to continue to drop off? And that's not necessarily a bad thing. This could just mean that the small caps are continuing to outperform the QQQs. But where the real strength in the indexes come from are when the big mega cap stocks and the NASDAQ 100 is outperforming. Semiconductors to the Dow. Saw some profit taking and some weakness in semiconductors where the Dow actually held up a bit better. We're coming down and dropping slightly below this breakout point of this ratio. And we look at the Qs, the 3 to 7 year bonds pulling back into the rainbow, but so far not seeing any real sustained or big time weakness here. Then we look at the broad market as measured by the S&P 1500 with short-term bonds also pulling back, but still just coming into the top end of the rainbow. Another broad market measure looking further out with 3 to 7 year bonds coming back into the top end of the rainbow. This is actually positive. The home construction ETF versus 3 to 7 year bonds. We were watching this and I was pointing this out that we had come all the way down with this ratio to the 250 period moving average. Well, we did that last October, and then this really bounced up and we saw a nice big upward move in the whole market. Well, we're still seeing this really hanging in there for the time being, as the potential of interest rates declining helps the home construction area. Now we switch over and look at the negative side. This is an intraday chart, and this goes all the way back to a week ago Friday, where we were looking pretty positive. You can see my cursor here, but then we saw some late day selling. Okay, that's not necessarily shocking in and of itself. It was during the last 30 minutes. Each one of these bars is 10 minutes, but it was before the weekend. And so you're like, okay, these things happen. But then when it happened again on Monday, where we went up and set a new intraday all-time high and then started to see some weakness, there was a kind of an attempt to bounce from there. But then we ended up closing at the low. These two taken together was causing a lot of concern for me. And as I was watching things play out, we did see a bit of a bounce up on Tuesday, and we actually set another new all-time high. But then some news broke out that had to do with the large caps, specifically the semiconductors, and that ended up gapping things lower even before the market opened. We saw most of the decline before the market even started on Wednesday, and we really didn't see an awful lot of movement, even though we didn't see a lot of buying into this either. When things really started to turn more negative was on Thursday, where we had a higher open. We went up, we hit this resistance level, and then everything just shifted after that. And we started to go down. We were breaking below resistance. Right in here was the 20 period moving average that was trying to hold up as support. But then we ended up breaking down below it and we hit this S3 level. And then we bounced up off of that. And we were able to close right back up at the 20 period moving average. So at that point, support was still holding. But then on Friday, we had a flat open. And then not too long after that, we saw selling coming in. We dropped below the 20 period moving average. We dropped below the support level. We're coming down now and looking at 5,500 as being the support level. And that's just about where we closed in Friday's session. So when you take all of this together in context, things are not looking really positive at this time. Then we're also turning back more negative when we look at sentiment. We had been going up above 50, and we tend to roll with that and go with it, and it was seen as more positive. But as the market's been coming down, sentiment has been going down too, and we're actually back into the neutral camp. Then looking at our trend analysis here, this is a short-term ADX, where the one that I focus on the most is intermediate term. We had been coming up and giving a very high reading with the ADX. Usually when we get above 40, that's a warning sign to us. And you notice we got back up here back in December. And it doesn't necessarily mean everything's going to fall apart. It just means the trend is starting to weaken. Well, we've been coming down, suggesting there's a weakening trend, but we're still above 40. So we're getting an extreme positive reading here. What's concerning to me is the green line is coming down and actually kissing the red line. If this crosses over and we see the green line going below the red line, that's going to turn our short-term trend even more negative. We're already negative because we're below the 20 period moving average. This would turn it even more negative. We're also seeing that weakness in the intermediate term trend. Now they're a little farther apart from each other. We're also coming down, showing a weakening trend. We're still above 40, but if the green line crosses below the red line, that's going to turn our intermediate term trend more negative as well. The VIX really shot up as we were seeing just low reading after low reading. Well, in Friday's session, we really spiked up on a closing basis. You can see this wild bar just flying all over the place. And that just means there's a lot of fear coming back into the market. We also saw the VIX of the VIX show that the VIX, the volatility of the VIX is really starting to pick up, both with the bar chart and the line chart. And then this is the Tom Bowley research, where we had been down under this 13 area And that's when we get the best annualized returns. That's when the market is the strongest. We actually got up into 17, but ended up closing at 16.52 in Friday session. So we're still in this positive area, but you can see where the annualized returns really drop off. We look at the momentum of the VIX, which is clearly up as measured by the MACD. Then the skew index, which the VIX uses at the money options to how it's calculated. The skew index looks at out of the money options, and we're just barely on the border of this red area, which means the market is anticipating some kind of a big move. It had already been up here and dropped, and now it's going back up into this red area. The context might mean that we could see more of a decline because we have some other indicators that are also suggesting there's still some real negativity out there. This is one of those charts. We take a correlation of the VIX to the S&P 500. We're above this dashed line. This is showing that the market is quite nervous right now. Now, this could still go up, but this is also giving us an extreme reading, meaning that the market is very nervous at this time. We look at the speed of the VIX. Now, this could actually slow things down a bit because when we use this with an RSI 9 to measure momentum, we've been up here for a few days now above the 70 level, and typically we don't stay up here for very long. So we might get some kind of a bounce, which could pull the VIX back down, but this could still go even higher than where it's at now. There's nothing to say it has to stop right here. And we're looking at a long-term chart of the equity put call ratio based on 5 periods. We had come down and we were dropping below this green line, which means that we were getting extreme here, meaning, remember, this goes opposite of stock. So this was extreme positive. Now, in a more solid environment, we would even drop below this, like what we've seen in the past. But for right now, we're actually starting to turn and go back up with our 5 period. This is another warning sign. We're also looking at a 10 period moving average of the equity put call ratio. It had been coming down, which is more positive. Now it's starting to turn and go back up. That could be more negative. This is also negative, the accumulation distribution. This is one of our smart money indicators because it measures not only price direction, but also the volume going into these moves. And so we label this as a smart money indicator. This is starting to drop below the moving average. And as measured by the boom indicator, it's dropping below 0. So this is actually turning negative now. We're also turning negative, and we have been for the last 2 sessions. Another smart money indicator is the Chaikin money flow. This had been concerning as we were going up with the S&P. This was actually dropping off, showing us a negative divergence. Now it could be beginning to play out. Chaikin oscillators also below 0 and declining. This is another smart money indicator, which is now negative. Parabolic SAR, we have the dots on top as we've been declining. This is another primary indicator that has now turned negative. We look at intraday large cap growth versus large cap value. They're kind of even right now, but we had been seeing the blue line, which is large cap growth, outperforming. And it's not necessarily negative if value starts to outperform, but we want to see this over a longer period of time. Typically, when the market is stronger, we'll see the blue line above the red line, but even though they're on different scales, they're pretty much on top of each other right now. We're also seeing a bit of a breakdown here with S&P growth of value. This had been declining. That was causing some concern. We actually held up fairly well in Friday's session here. We'll have to see if we can get this going back up. That would be more positive. That means that more money's going into growth stocks, which are buy low and sell high, than they are value stocks, which tend to be more defensive. Then we look at the small caps. This is one concern that we're seeing. Even though we're breaking out with the small caps, the growth to value ratio has been declining. We're looking better with the mid caps, breaking out, giving back some of the gains, but the growth to value ratio has been declining. The S&P growth to value ratio has also been declining, and these are concerns that we're keeping an eye on. We're looking at a growth ETF versus a value ETF. This had been really outperforming. Now it's coming back down into the rainbow. Then we look at discretionary versus staples. It was looking a lot more positive, but since has been pulling back when we look at this ratio. And our growth to value ratios are really not showing any strength. A little bit of strength here with discretionary to the S&P. But when we look at the Qs to S&P, under the moving average, and large cap growth is underperforming large cap value. So with the large caps, mid caps, and small caps, even though the small caps and mid caps have done pretty well, these ratios are not doing really well, and that is a warning sign to us. And we look at the double and triple exponential moving average based on 20 periods. This had been holding up quite well. Now we're starting to drop below and the lines are starting to roll over. This is turning the short-term trend more negative. We're also seeing a bit of a breakdown here with the 50-period double and triple exponential moving averages. We're coming underneath both of the lines, and if we see more weakness here, the red line is going to drop below the blue line, and that's going to turn things more negative. We have dropped below the 20-period simple and exponential moving average. We held that level on Thursday. We lost that level on Friday. This is turning the short-term trend negative. Then we look at a 20-period simple moving average of the open, high, low, close. That produces this mini rainbow. We have seen in the past where this can often provide some kind of support. Well, it's one thing to drop down here, like what happened back in May, but we were able to end up closing inside of this mini rainbow. Well, in Friday's session, we actually closed below the rainbow. That's giving a little bit more concern to the short-term trend. Then we did see some new O's being drawn in with the point and figure chart. When we see X's, and this is not time dependent, this is just based on price. So however long it takes for the S&P to move up or down, regardless of time, that's what this measures. And it's called a point and figure chart. When we see a lot of X's, that means there's a lot of buying. And that's what we have been seeing. And we were working off of a positive signal that was generated in the middle of May. Well, that signal is now gone, and we're seeing zeros drawn in here as we've been seeing a pullback in the S&P 500. Then on a momentum basis, we're starting to look more negative here. On top are two short-term oscillators, which are now turning negative. The intermediate term oscillators are also turning negative. We're starting to roll over with the longer term oscillators as well, but we're not seeing it completely across the board, at least yet. The FANG index, after setting an all-time high, has been pulling back, but it's still above its 50-day moving average. The NASDAQ also pulling back, but still above its 50-day moving average. The same thing can be said here with the NASDAQ 100. We're watching this pivot point, especially on the NASDAQ 100, because we're also coming down, or the 50-period moving average is meeting up with this pivot point. So that could provide some pretty significant support. Then we look at the NASDAQ 100 bullish percent index. It did turn up a little bit, but we're below 50, so that is negative. And the momentum for the NASDAQ 100 continues to be negative. It's heading lower right now. The QQQs, they never did really stop at their 20-period moving average. They ended up opening right on it and going down. That was the first sign that things were getting a bit weaker here. We're still above the 50-period moving average. So we'll be watching to see if there's more weakness. Will this end up providing support? Then here's a weekly chart, and I pointed this out a week ago. It was a little bit concerning when we're going up and we see nice positive candles here. Well, then we see an open and then a range and then a close just about at the same point. That could be called a doji candle when you talk candlestick lingo. And then sometimes that can mark a reverse. And I pointed that out in last week's video, and we are seeing some weakness here. We're going to wait and see if we see follow-through weakness with this. And then the NYSE advanced decline line, it's declining as well as the S&P has been going down as well. And since they're going down, I put this on the negative side. And then we're looking at the Staples to S&P 500 ratio. When this is going down, that's positive for the S&P. When this is going up the way it has been, that's negative for the S&P. And Staples to tech ratio. When this is going down, that means tech is outperforming. We're seeing a bit of a bounce up here. We're wondering, is this going to continue? Are we really seeing a shift in the market, or is this just a short-term anomaly that will eventually get worked out? And we look at the Eurozone, which are stocks in Europe, and compare them with American bonds on a 3 to 7 basis. We're still seeing some weakness here. We've been chopping around inside the rainbow right now, so we're not really seeing any strength this way. And we look at the dollar, which had been declining. That was giving support to stocks. It's still in a longer-term uptrend, even though it's below both of its moving averages. And dollar strength will probably put pressure on stocks. If we see the dollar down, that could give support to stocks. Then we have this thing called the Hindenburg almond, and the perma bears just love this. And if you want to pause this and look at, this is all the definition of it right here. What I just focus on is the chart itself. All the parts that are talked about in this long description are put together into one indicator here that's developed by stockcharts.com. We did get another spike on July 9th. Okay. Now, what we're waiting to see is within 20 trading days, which would be August 2nd, we need to see another spike up here, and that would be a confirmation. We've seen these things happen before. This was right at the end of 2019 before we saw not a huge downturn, but it was still a significant pullback. This is right before the COVID crash, and this was at the high set back in late 2021. So if we see a confirmation here, that we're probably going to have to pay attention to that. But we're seeing all kinds of confirmation signals here with the NASDAQ, but the NASDAQ just kept going up anyway. So we'll just have to see how that plays out. So thank you. I really hope you found this helpful. I hope you have a really good weekend, and I will talk to you in the next video.